Continuing the conversation here, we're tracking stock futures. They are higher as of right now for the U.S. major averages following 3 straight days of losses for the markets since Powell's hawkish tone at Jackson Hole. Inflation continuing to be enemy number one for the Fed, as noted by our next guest, Keith Lerner, Truist Chief Market Strategist. Keith, always a pleasure to speak with you and get some of your insights here. First, let's go back to Friday, where we had Fed Chair Jay Powell out there in Jackson Hole, and in just 8 minutes, rattled the market so much that we're still seeing the impacts even here through Tuesday, and perhaps we'll see exactly where Wednesday nets out as well.
Yeah, well, first of all, great to be with you all as usual. First, I think some context is helpful heading into that speech. In mid-June, this market was pricing in a recession down about 24%. It went from pricing in a recession to pricing in a soft landing, a pretty optimistic scenario at the highs. And that's why heading into that speech, our view and advice to our clients was this was a good time to trim equities because we were pricing a lot of good news. And that Powell's meeting or his speech was really consistent with what we've been talking about. The scar tissue from the last year of inflation means the Fed is going to be much more conservative in providing support to this market than they have the last 10 or even 20 years. So I think that's a really important point. The scar tissue means the game has changed.
Keith, I'm going to try hard. I'm not going to ask you how inflation and rate hikes will help or won't help Bed Bath & Beyond. We'll save that for an off-chat conversation. But look, September is now here, my friend. How do you think the market is going to perform versus historical norms, given where we are in the rate hiking cycle?
Yeah, well, it's a good question. I mean, historically, September is the worst month of the year. The only thing I will say, Brian, we've been more on the negative side. Short term, we have corrected about 8% in 2 weeks. And one of the indicators we just looked at this morning showing the percentage of stocks in the S&P that are oversold now is about 70%. That's the most since those June lows. So I actually think short term, we'll probably find some stability here. I do think that September and October into the midterms will still be kind of choppy waters. But again, after the selling pressure, at least I think we'll probably see a little bit of a reprieve, at least some stability here near term. And that's what we're seeing today. Things don't move in a straight line.
Are there any sectors that you are convicted to still have some type of positioning in or even increase a position in?
Yeah, the sector side, what we're having right now is really a lack of leadership. So, I don't know that there's really high convictions within the sectors right now. I would say where we've been focused on mainly has been more in the defensive areas like staples, like healthcare that can kind of manage through this slow down the economy, expect and more of this choppy market. We also like energy, and we've been overweight energy for over the last year. That's coming under a little pressure here short term, but I still think the structural positives are still there. But I think the one thing we'll be looking for, especially this month and over the next, maybe few months, is where does that leadership come from? For right now, almost 50% of this market is concentrated in growth, tech, communications, and discretionary. For this market to actually get some legs, you'll need to see some participation from those groups. And at this point, we haven't seen it as of yet.
Keith, when you talk to investors, what are some of their top concerns besides what's going on at the Fed?
I think it's inflation is enemy number one, just like it is for the Fed. So I think that's top of mind. Recession talk is out there quite a bit. I mean, the overall sentiment is still on the negative side, Brian. You can see that in the surveys. You can see that even in some of the fund flows here more recently as well. So I think people are concerned about just all the complexity of this market cycle that we're in, and people are just concerned about the downside of the market. So, I mean, I guess one asset for this market is people already braced for bad news.
Keith, just while we have you, we continue to hear about more layoffs that are coming forward. And this morning from Snap, as we've also been parsing that with some of the private payrolls data that's come out from ADP. What do you think the likelihood is that we actually do hit an unemployment rate eventually, and at what time scale perhaps, that we hit an unemployment rate at about 4.5% or even as high as 5%, as some economists have called for?
Yeah, I'm not an economist per se, but I do think the main thing is that that unemployment rates are likely going to move higher, and then the Fed's actually projected that. The question which you brought up is a good one: is how soon? With all the central bank tightening, with all these supersized hikes, it's hard not to see the economy slowing by the end of this year and early into next year. So I do think we're going to see some upward pressure. But interesting this week that the JOLTS report, job openings actually went increased, and that's the opposite of what the the Fed has wanted. So I think the stronger this labor market stays, the more pressure that the Fed is going to continue to have to push rates higher. So I do think that employment will weaken towards the back half of this year and into next year. And I think that's going to be, an overall negative for the market as we move, again, later into this year, into next year.
Tough job for the Fed indeed. Keith Lerner, Truist Chief Market Strategist. Always good to see you. Have a great Labor Day weekend.
You do the same. Thanks so much, guys.